Hey everyone, welcome back to the channel. Today we're going to take a look at Palantir. The last time I made a video on them was actually back in 2022, and it was surprisingly one of the few times I thought a company was actually potentially undervalued. They were trading around a market cap of 15 billion at that time, and I ended up getting a valuation between 25 and 32 billion, depending on how we treated stock-based compensation. Since that time, Palantir stock has actually surged and is up almost 400% from a low around $7.50 per share all the way to just above $28 per share at the time of making this video in July of 2024. This translates to a market cap of just over $60 billion today. I was hoping when I would refresh my model, I would actually pull down their 2022 and 2023 full year results and see that they far exceeded the projections that I had back in 2022. And maybe that would help explain the insane share price appreciation. Unfortunately, that wasn't the case. Things actually look pretty similar to what I had projected back in 2022. And as of today, I would actually not enter a position into Palantir stock. I know this is gonna get me a few angry comments below, but the reality of what I am seeing in their financials doesn't reflect the company's current share price with a 200+ price to earnings ratio. So let's quickly hit on the company performance over these last 2 years compared to the share price. Revenue for 2022 did well. It came in at 24% above 2021 levels at $1.9 billion. And 2023 continued to show a strong top line revenue growth of 17% and landing at $2.2 billion in revenue. That is pretty good revenue growth, don't get me wrong, but it's not good enough to justify trading at a 200+ price to earnings. Which brings me to the next topic. In 2023, they finally showed a positive operating income, which is great. It shows they are finally cutting costs or revenue is growing faster than their costs. Either way, it's a great sign. However, they still have insanely high levels of SG&A compared to their revenue, coming in at a whopping 42% of revenue in 2023. And this is excluding stock-based compensation. When you actually add back stock-based compensation to this number, it jumps to over 50% of revenue. They're hiring and spending as if they are a high growth firm. The unfortunate reality is their revenue isn't growing fast enough, in my opinion, to actually support this level of spending. Nvidia is growing around 100% annually on a revenue base that is 10 times higher than that of Palantir. They grew revenues from $30 billion all the way to $90 billion in 2 years. If they wanted to spend money, go at it. Now, this entire video, I'm not going to talk poorly about Palantir. I actually really like their business. They have a very impressive gross margin. If we look at 2023, they generated revenues of 2.2 billion and only had 395 million of associated cost of goods sold, leading to a gross margin around 80%. That is very impressive. They have also done a tremendous job cutting stock-based compensation. In 2020, stock-based compensation was actually 116% of revenue. They paid out more in stock-based compensation to employees than they generated in revenue. That is absolutely crazy. Today, that level is down to 21%, and it appears to be trending down further. SG&A has trended down, but not fast enough in my opinion as well. They also report their revenue by customers, and their top 20 customers have actually dropped from being over 60% of total revenue down to 49%, which is actually a very good sign to see. This shows more diversification in their customer base and gets us away from a concentrated risk. During this time, they've also grown their customer base from 139 customers in 2020 all the way to 500 customers in 2023. So I do believe there are a lot of great things that Palantir is doing. I just believe the market exuberance around AI has pulled Palantir into a state of being overvalued. Now, let me quickly hop into my most recent model and I'll walk through my analysis and my assumptions. If you're new around here, I wanted to quickly point out that you can follow along to any of my valuation videos. All you need to do is scroll down to the description and there will be a link for the model. You will need to make a copy of this model, but that will then grant you edit access so you can follow along and adjust my assumptions as needed. So first, I model revenues based on customers, and I actually do this on the income statement tab. I have their customer base continuing to see strong growth, going from 500 customers all the way to 1,900 customers in a decade. This brings revenues from 2.2 billion in 2023 all the way to 7 billion in 2033. Now onto the cost. For COGS, I've held it flat at 18%. This could tick down slightly as revenue grows, as they have shown that an incremental dollar of revenue actually costs them less to support than the previous dollar of revenue, but I like to be conservative, so I will leave it flat. For SG&A, I have this decreasing by around 3 to 4% annually. I think if Palantir came out and said they would do a restructuring and cut jobs and focus on cash flow, then you could actually be more aggressive here. But I get it. They want to be a high growth tech firm. And to do that, you need to spend money. Especially for Palantir, they need to lobby for government contracts and the like, as the government does make up a huge portion of their revenue. R&D seems pretty good to me already, around 14% of revenue, and I have it ticking down ever so slowly to around 11% in a decade. Stock compensation, I've assumed they're actually going to continue to cut this and normalize out around 6% of revenue, like some of their peer firms. These assumptions get our cash flows in 2024 almost doubling from what we saw in 2023. And going from 2024 to 2033, cash flows triple, going from 913 million on 2.6 billion in revenue to 3.2 billion on 7 billion in revenue. This is pretty strong growth on both the cash flow and top line level. All of this actually gets us a valuation around $33 billion. This implies the market is about double where I think they should be. Now, the thing about Palantir is it is actually a very good business. The products are incredibly sticky and the margins are very good. So in my opinion, when the bubble pops on AI or slowly deflates, I think we could actually see an overcorrection to all the AI stocks. I will definitely be keeping my eye out for Palantir at that point. And if the stock dips back down to a $10 to $15 range, I could actually see a very strong case to make a purchase. If you're bullish on the future of AI or in corporate America, and especially the government agencies. So there it is. I think they are overvalued, but once again, I really like the business model. And I think regardless of current market exuberance, they will continue to grow at a healthy clip with impressive margins. Now they just need to cut costs or somehow amplify growth to justify the current valuation. Anyways, that's all I had for today. Thanks so much for watching and leave any comments below.